Welcome to this explainer. Today, we're going to take the notoriously dry rules of hire purchase accounting and transform them into a crystal clear study guide. And we're focusing entirely on the purchaser's books. Seriously, if you've ever stared blankly at a balance sheet, just wondering how on earth you're supposed to record an asset you're paying off in chunks, well, you're absolutely in the right place. Let's get into it.
Here's our syllabus for today. We're going to cover the dilemma of possession versus ownership, go over a pre-recording checklist, walk through Method A and Method B, tackle a classic exam trap, and finish up with a final review.
All right, Section 1, the dilemma, possession versus ownership. Okay, so picture this. You just bought a massively expensive machine. You're using it today, right there on your factory floor. But here's the catch. Legally, the title doesn't actually pass to you until you make that absolute final payment. So how in the world does that hit the books? I mean, you have the physical asset sitting right in front of you, but technically, it isn't legally yours yet. That weird gap between physical possession and legal ownership, that's the exact puzzle we're solving today with our journal entries.
Moving on to Section 2, the pre-recording checklist.
Listen, before we even think about touching a debit or a credit, you need a game plan. Think of this as your absolute must-have checklist. You literally cannot accurately record these transactions without knowing every single one of these 7 variables. Sure, you need the basic dates and the interest rates, that's a given. But you absolutely have to nail down the total cash price, which is what it costs if you bought it outright today, versus the hire purchase price, which includes all that deferred payment interest. Getting those 2 specific numbers straight is absolutely critical before you even open your ledger.
Let's jump into Section 3, Method A, full cash price.
Now, the crucial point to remember here is that under Method A, you're going all in right from day one. You're operating under the assumption that you will absolutely, without a doubt, make every single payment to eventually acquire that legal title. And because of that confident assumption, you just treat it like you bought the asset outright using borrowed money. You record the asset at its total, full cash price immediately upon taking possession. Bam, done.
Okay, let's walk through the chronological journal entries for the asset lifecycle using this all-in method. Step 1. On the exact date of purchase, you debit your asset account and credit the hire vendor's account with the full cash price. Boom, it's fully on the books. Step 2. For your initial down payment, you debit the hire vendor to reduce what you owe them and credit your bank. Easy enough, right? Then, in Step 3, when an installment becomes due, you debit the interest account and credit the hire vendor. Finally, Step 4. When you actually pay that installment, you debit the vendor and credit the bank. You're just steadily, systematically knocking down that vendor account with each passing payment.
So how do we close out the year under Method A? Well, you have to record the wear and tear on your fancy new asset. In Step 5, you charge depreciation by debiting the depreciation account and crediting the asset account. Then we hit Step 6, the year-end transfer. Here, you debit your profit and loss account and credit both the interest and depreciation accounts. This just sweeps those expenses right into your P&L. Honestly, it's a very clean, straightforward approach that gets the full asset value recognized right out of the gate.
All right, let's look at the other side of the coin. Section 4, Method B, actual cash paid.
Let's kind of reset our mental flashcards for a second. What's really fascinating about this alternative method is the complete philosophical shift. Here, we only record the asset value that we have actually paid for out of pocket. This aligns perfectly with that delayed legal ownership concept we talked about earlier. Because legal ownership does not officially pass to you until that very last installment is made, we do not just dump the full price onto the balance sheet on day one. We take it slow.
Notice the massive difference here in Step 1. You take physical possession of the asset, but you pass no journal entry at all for the purchase. Zero. Nothing. I know, it feels totally counterintuitive, but it's exactly right under this method. The asset account doesn't even get touched until Step 2, which is when you make your first physical down payment out of the bank. At that point, you debit the asset account and credit the bank account. You are literally building this asset on your books piece by piece as the cash actually leaves your hands.
Now, as each installment comes due in Step 3, it gets a little tricky. You have to split the entry. You debit the asset account just for the cash price portion of the installment, so you're adding another small chunk of value to your asset. At the same time, you debit the interest account for the interest portion and then credit the hire vendor for the total amount. Finally, in Step 4, when the installment is actually paid, you simply debit the vendor and credit the bank.
Next up, Section 5, the exam trap, depreciation rule.
Okay, I need you to pay very, very close attention here. This is the exact spot where accounting students always, and I mean always, lose points.
Even if you're using Method B and you're only recording the asset incrementally as you pay for it, your depreciation calculation is still based on the asset's total full cash price. Why? Well, think about it. The physical asset is degrading and losing value at its full capacity out there on the floor, regardless of how much of it you've legally paid off. So never, ever calculate your depreciation just on the installments paid. Always use the full cash price. No exceptions.
The good news? The actual journal entries for depreciation at year-end are perfectly identical in both methods. Step 1. Debit depreciation, credit asset. Step 2 is your year-end transfer. Debit profit and loss, credit interest and depreciation. The actual mechanics of these entries don't change one single bit. Just make absolutely 100% sure you use that full cash price figure from your checklist to calculate the actual debit amount.
Finally, Section 6. Study Guide Final Review, Comparing Methods.
We are in the home stretch now, folks. Let's lock in everything we've covered today. Looking at these two methods side by side brilliantly illustrates the core differences. Notice how Method A hits the asset account completely on day one for the initial purchase, while Method B passes absolutely no entry. For the down payment, Method A just reduces the vendor account, while Method B starts slowly building up the asset account with the down payment and the cash portion of each installment. It's really the perfect mental summary of two completely different accounting mindsets.
As we wrap up this explainer, I want to leave you with a final thought to chew on. As you're studying these entries, remember this. You might have physical possession of the asset, but do you actually have the title? Because if you default, that asset just disappears. Poof. It's a pretty powerful reminder that in business, physical possession isn't everything. Mastering these specific journal entries is exactly how you keep rigorous track of what is actually legally yours. So look at your books and ask yourself, who really owns your business?